All right, so you guys have really outdone yourselves this time. This stack of stuff you sent over about how the U.S. and Asian economies are all tangled up, well, let's just say it's a lot to untangle.
Yeah, definitely a lot to dig into.
But that's exactly what we're here for. The big question we're tackling today is what happens over in Asia if the U.S. economy takes a hit? It starts to slow down, maybe even dips into a recession. We're going to look at where things get shaky, but also at some bright spots, some real surprises, actually, that popped up in all these articles and analyses you sent. Think of this as your cheat sheet to understanding these global economic currents, everything from how trade is linked up to which industries are feeling the pressure, the tricky policy decisions governments have to make, lessons learned from past crises, how the markets have been reacting, especially around March of last year, and yeah, those surprisingly resilient parts of Asia we mentioned. Ready to jump in?
Absolutely. Let's do it. And I think your sources make it super clear just how interconnected this whole picture really is. The thing that kept coming up over and over again was how much a lot of Asian economies depend on the U.S. to buy their stuff, their exports.
Yeah, that makes total sense. It's like supply and demand, but on a global scale.
Yeah.
If Americans, regular people, and businesses stop spending as much, the first ones to feel the pinch are the ones selling to them, right?
Exactly.
And we saw some numbers that really drove that point home, like Japan, South Korea, Taiwan. They send a huge chunk of what they make, sometimes as much as 20%, straight to the U.S. Singapore and Malaysia, too, they're really big on exports, so they're in that high-risk group as well. So they're not only exposed to the ups and downs of U.S. demand, they're also super sensitive to any changes in U.S. trade policy or, when the U.S. starts getting competitive on technology.
Right. And then if you look closer at the types of stuff they're exporting, tech products are like a flashing red light.
Uh-huh. I see where you're going with this.
Think about all those semiconductors coming out of Taiwan and South Korea. If demand for electronics in the U.S. goes down, well, giants like TSMC and Samsung, they're going to feel the squeeze. And actually, we saw a glimpse of that back in March last year when their stock prices took a dive.
Oh, yeah. Those stock prices were a real canary in the coal mine, weren't they? And it wasn't just them. The whole market was spooked. Both the TIIX in Taiwan and South Korea's KOSPI, they both dropped big time, over 3%. And a lot of that was because people were getting nervous about tech spending slowing down globally.
Yeah.
But okay, now China's the elephant in the room here. They're a massive economic force, but it seems like they're in a bit of a different position when it comes to the U.S., right? It's not like they're relying on U.S. exports as much as they used to.
That's true. Their reliance on the U.S. has definitely shifted. But here's the catch, Ackley. Their ability to cushion the blow for other Asian economies, if the U.S. does go into recession, well, it's not what you might think. Right now, their own demand at home is pretty weak, and they're grappling with deflation. And that's a whole other issue because falling prices can actually make people and businesses less likely to spend and invest, which weakens their economy even more. So even though they might not be directly exposed to the U.S. through exports as much as some of their neighbors, they might not be strong enough to pull everyone else up if things go south.
So the powerhouse of the region might be sputtering a bit itself. And it's not just about the physical stuff moving back and forth, right? We have to factor in the financial side, too, how money flows between these economies.
Oh, absolutely. If the U.S. dollar gets stronger during a recession, which happens pretty often because investors tend to flock to what they see as safe havens, well, that puts a lot of pressure on Asian currencies. It's like this. If the dollar becomes more valuable, you need more of the local Asian currency to buy the same amount of dollars, which means anything priced in dollars, like a lot of imports, gets more expensive. And that can drive up import costs in Asia and potentially lead to, good old inflation.
Right. Makes those imported goods pricier for Asian consumers.
Exactly. And then there's this thing called capital flight, which can really shake things up. When investors get nervous about economic instability, they often pull their money out of places that seem risky, like emerging markets in Asia, and park it in places they think are safer, like, yep, you guessed it, the U.S. This capital flight makes Asian currencies even weaker and can strain their financial systems.
Wow, so it's a double whammy. More expensive imports and potentially money flowing out of the region. And, we've talked about tech, but it feels like this ripple effect would spread much wider than that. We'd see a kind of tightening of the financial belt all around. And all this financial pressure, combined with the direct hit to demand, it's bound to have some serious consequences for specific industries in these economies, right? So let's break that down. Let's look at the sectors and regions that are particularly vulnerable.
Yeah, and I think the market freak out back in March of 25 really showed just how sensitive tech stocks and the whole manufacturing sector are across the board.
Yeah.
Those drops we saw in the Taiwanese and South Korean markets, those weren't isolated incidents. They were like a warning sign that people were seriously worried about a U.S. economic slowdown, triggering a domino effect on global industry. And like you said, big players like TSMC, Samsung, even Foxconn, which is a crucial part of making electronics for the whole world, they all took a major hit to their stock prices.
Yeah, and it's kind of amazing how differently the impact is playing out across Asia. The stuff you sent over, it actually breaks it down pretty neatly into countries with high, moderate, and low exposure to all of this.
It does, and if you look at the bigger picture, you see this clear spectrum of how vulnerable different countries are. Japan, South Korea, and Taiwan, they're all in that high exposure group, mainly because they're so deeply embedded in global tech and manufacturing supply chains and because they rely so heavily on U.S. consumers to buy their products. Then you've got the moderate exposure group, countries like China and India. And then on the lower end of the spectrum, economies like Australia and Indonesia, they seem less directly affected by a potential U.S. recession, at least through the usual trade channels.
Which makes sense when you think about how their economies are structured, what they focus on.
Mm-hmm.
But we can't forget about the smaller players, right? Those economies have their own unique set of issues to deal with.
Exactly. Places like Thailand and the Philippines, they depend a lot on money sent back home by people working abroad, those remittances, and they also rely heavily on tourism. A U.S. recession would likely mean less money coming in from both of those sources, adding even more strain to their economies.
So it's a real web of potential problems, all interconnected. And even beyond those broad country categories, there are certain sectors across Asia that seem like they'd be hit especially hard.
Definitely. If you zoom in on the specific sectors, manufacturing, especially anything related to technology and cars, think Japan here, that's looking really vulnerable. And then there's the whole mess in China's real estate market. That's not just a headache for them, it could trigger problems across the entire region. And then there's financial services. Smaller businesses might find it much harder to get loans as things tighten up. The tourism industry, while it's recovering in some spots, it's still shaky and could easily take another hit. And then you've got the rising costs of energy and all those other raw materials, commodities, which are squeezing profits across the board. Even agriculture might struggle, especially with concerns about food security becoming more urgent if trade gets disrupted.
So we're seeing this really intricate picture of vulnerabilities all over the Asian economic landscape. So given all of this, what can Asian governments and their central banks actually do? How do they try to steer through all this potential turmoil?
That's the million-dollar question, and honestly, they're facing some real limitations. One of the biggest hurdles is monetary policy. The U.S. Federal Reserve has already started tightening things up, so Asian central banks don't have as much room to slash their own interest rates. If they do, they risk a flood of capital leaving their countries and their currencies taking a nosedive. And, the 1997 Asian financial crisis, that's a really stark reminder of how this can backfire. Back then, countries like Indonesia and the Philippines, they actually raised interest rates to try and stabilize their currencies, but it didn't work. And some argue it actually made the crisis worse.
So they're walking a tightrope, trying to find the right balance. What about fiscal policy, government spending, and those kinds of stimulus measures? Could that help?
Yeah, well, fiscal responses come with their own set of complications, especially for China. Like we talked about earlier, they're already dealing with deflation and weak consumer spending, so it's not clear how effective those big, broad stimulus packages would actually be. And then there's the question of where that stimulus money would even go. Would it go towards encouraging people to spend more? Or would it mainly be focused on investments in things like infrastructure, which is more of a supply-side approach? It's a tough call.
So the usual toolkit might not be as effective this time around. It's always useful to look back at history, those big moments that can give us some context and teach us some lessons. And when it comes to Asia and economic shocks, there are a couple of major crises that immediately spring to mind.
Totally. The 1997 Asian financial crisis is a big one, a real wake-up call. It showed how the U.S. tightening its monetary policy, combined with a sudden rush of capital out of the region, could destabilize even economies that seemed pretty strong. It led to some really severe currency devaluations and had huge social and political consequences, especially in Indonesia. That was a really tough time.
Yeah, a painful experience for a lot of these countries, and one that probably shaped how they've responded to economic challenges in the years since then. And then, of course, there's the 2008 global financial crisis, which had worldwide implications.
Yeah, '08 hit Asia hard too, causing a huge drop in exports as demand around the world dried up. But they bounced back relatively quickly, largely because China pumped a massive amount of money into infrastructure projects. What's interesting now is whether that same strategy would work again, given all the economic issues China's dealing with at the moment. So while they recovered then, the playbook might need to be totally different now.
So their options for handling a slowdown coming from the U.S. might be more limited this time. Now, you mentioned those market reactions back in March of 25. Let's dig into that a little more, along with the broader patterns of how Asian markets have been responding to all this, the U.S. economy and those ongoing trade tensions.
Yeah, that market downturn in March really highlighted how quickly anxieties about a U.S. recession can spook investors in Asia. We saw some pretty big drops across major stock markets. Japan's Nikkei index went down almost 3%. Hong Kong's Hang Seng fell 1%. South Korea's Kospi dropped 2.6%. And there were similar downturns in Australia, Shanghai, and even Thailand, although Thailand also had to deal with fallout from the earthquake in Myanmar.
Yeah, a clear sign of just how connected those markets are and how fast things can change when sentiment shifts. So how did investors typically react during this period of uncertainty? What did they do with their money?
Classic flight to safety. They pulled their money out of stocks, which are seen as riskier, and moved it into things that are perceived as safer, like the Japanese yen and government bonds. That increased demand for those safe havens actually made the stock market volatility even worse.
And this wasn't just a one-off thing in March of 25, right? Asian markets have been showing signs of stress for a while now, and a lot of those signs seem to be linked to the U.S.
Right. It's been building for a while. The pressure on Asian markets is coming from a bunch of different factors, not just fears of a U.S. recession. You've got what's happening on Wall Street, those persistent trade tensions between the U.S. and China, the fact that China's economic data hasn't been as strong as people expected, rising bond yields, which usually means tighter credit conditions, and then each Asian economy has its own domestic challenges to deal with. There were even reports that China was thinking about retaliating against the U.S. by slapping tariffs on agricultural products, which added fuel to the fire.
So it's a really complex mix of worries weighing on investor confidence in the region. And this trade war between the U.S. and China, that's been a constant source of uncertainty even before things went haywire in March of 25.
Oh, absolutely. Even before that, every time those trade tensions flared up, we saw Asian markets take a hit. For example, when the U.S. announced new tariffs, Japan's Nikkei index took a tumble, especially companies in the auto industry. The broader MSCI Asia-Pacific index, excluding Japan, also went down, along with markets in South Korea and even some of the big, stable Chinese companies, those blue-chip stocks. And this was despite some positive economic news coming out of China at the time. It shows just how sensitive these Asian economies are to U.S. trade policy and how deeply interconnected they are.
Yeah, it really highlights how intertwined they are in the global economy.
Right.
So let's zoom out a bit and think about the long-term implications. If the U.S. economy does go through a prolonged downturn, what might that mean for Asia down the road?
Well, in the long run, it could actually speed up some of the changes that are already happening. We might see Asian countries working even harder to diversify their trade relationships, maybe relying less on the U.S. dollar for international transactions.
Yeah.
But in the short term, we should expect to see more disruptions to global supply chains and how capital flows around the world. This is especially true for those Asian economies that have a lot of debt or rely on exporting a very narrow range of products.
So there could be some pretty big changes to the global economic order, but it's not all doom and gloom, right?
Yeah.
You mentioned that some parts of Asia are actually showing resilience despite all these challenges. What's going on there?
That's a really important point. While a lot of Asian economies are facing headwinds, some are doing surprisingly well, even showing strong growth. India is a prime example. They're a major economy that's expanding rapidly, with projections for strong growth in both 2024 and 2025. They've got strong domestic demand, and they're becoming a major player in the digital world. Vietnam is another one. They've become this magnet for foreign investment in manufacturing. And then you've got Indonesia, with their huge domestic market and tons of natural resources, which gives them a bit of a buffer. Even Bangladesh is seeing steady growth, thanks in part to their strong garment exports. And smaller economies like Bhutan, they have positive growth forecasts too. And across the ASEAN region, tourism is bouncing back in places like Thailand and Malaysia, and they're trading more amongst themselves.
It's a good reminder that Asia is not a monolith. It's this incredibly diverse collection of economies, each with its own strengths and weaknesses.
Exactly. The countries that are doing well, they usually have a mix of strong internal demand, governments that are proactive with their policies and reforms, or they have advantages in certain key industries that let them navigate all this global economic uncertainty more effectively.
So, to sum up our deep dive here, It's pretty clear that if the U.S. economy sneezes, Asia is likely to catch a cold. We've seen how interconnected they are. We've talked about the vulnerabilities, especially for those economies that are deeply plugged into global supply chains and rely heavily on exports, particularly in tech. But it's crucial to remember that the impact won't be the same everywhere. Some countries, because of their domestic strengths and smart policies, are showing real resilience.
Couldn't have said it better myself. The big takeaway here is that while the ripple effects from a U.S. economic slowdown will definitely be felt, the fact that Asia is so diverse economically means some countries will handle it much better than others.
Well, this has been a fascinating deep dive into a really important and complex topic. It definitely gives us a lot to think about. And for you, our listener, we want you to think about how these global economic forces might be shaping your own understanding of international trade and investment. Are we seeing a shift in global economic power happening right now? And of all the things we've talked about today, what really piqued your interest? What are you going to go research on your own? Thanks for joining us for this deep dive.